Should you really sell in May and go away? Or should May be celebrated? The logic behind this spring slogan is that the S&P 500 has averaged a return of about 2% annually from May to October versus about 7% from November to April. But does this work and can it help you? Well, that depends. Let's start out by looking at the performance of the S&P 500 since 1993, so over a 31-year period, versus the orange line, which is the sell in May and go away strategy. So basically you sell at the beginning of May, you buy back at the very last day of October, and you can see what happens here. So clearly the S&P 500 handily beats the sell in May and go away strategy. But why is that? Well, if you take a look at the gains or losses of May through October, you can see that most of them were gains. So you were giving up all of these gains every time you did that. Now, did you miss some big drawdowns? Yep. And what effect did that have on your portfolio? Well, if we go back here and look, you can see that you did benefit. There was a big drawdown from 2000 to 2002, 2003. And you can see that the sell in May strategy, while it didn't go as high, it also didn't go as low. And then again, back here in 2007 to 2009, you can see that, again, it wasn't as high, but it didn't drop as much, although it did drop here a bit. So, yeah, it sort of looked like it helped. And how does that show up? Well, if we take a look at the gains and losses, you saw that chart with the 23 gains and only 9 losses. But if you look at the annual rate of return, compound annual growth rate, the S&P 500 had a 10% annual growth rate, while the sell in May and go away strategy had only a 7% compound annual growth rate. Now, this assumes you're not paying any taxes on the gains when you sell. So the only place it would make any sense to do this is in a retirement account, but I wouldn't recommend that either. Now, where did you gain? And we showed this in the graph. The S&P 500 had a 55% loss, while the sell in May and go away strategy had a 34% loss. So some benefit there. But if you really want to do better without all this nonsense, watch my 2 videos, the ideal portfolio using just 2 ETFs or mutual funds, or the ideal portfolio using individual equities. Both are in the pinned comments below. If you want to perform better than the sub 3% average investor returns, you have to stay level-headed in the face of market fluctuations. By staying the course over the long term, as you've just seen, you'll achieve better returns and a more satisfying long-term investment success. With all that, let's take a look at what the charts and metrics are telling us about the current state of the markets. Well, if we take a look at the equity markets over the past 5 days, you can see we've had a very healthy-looking situation here. ARK Invest finished way on top, well above all of the other indices. NASDAQ in second, that's great. S&P third. Small caps, we'd like to see these up higher, but they did okay. And the Dow last. So this is a fairly healthy looking risk appetite. What about over the past month? Well, you can see we had a nice rally, a pullback here, and then we're back in rally mode. So this is starting to look good. And in this situation, the small caps are leading the charge. What about year to date? Well, year to date, everything's up except ARK, and ARK has really been kind of struggling here. But if this market continues higher and interest rates start to fall later this year, I fully expect ARK to launch ahead of these other 4 indices. And what if we look back over the past year? Well, over the past year, you can see that the NASDAQ's leading the way, followed by the S&P. And because of the big pullback that ARK has had, it's down here in last place, but it still has a fairly healthy gain for the past year. And what about the current bottom dynamics? Well, if we take a look at the bottom dynamics, we had, as I've mentioned before, we had a bottom forming indicator back here, and you can see we had a bottom forming. We had the bottom forming indicator nicely up here in the, call it somewhere north of 90% range. The confidence level wasn't quite as high as I'd like to see it, but it was fairly high. And then we had an attempt at a bottom confirmation here. You can see that twice the bottom confirmation signal has been up here right at 100%. So this is very strong, but the confidence level is way down here, below 60%. In fact, more recently, it's heading lower. So there's not a conviction and a sense of herd mentality driving things higher right now. So a little bit of tentative behavior in these metrics here. And what about risk versus opportunity? Well, if we take a look at risk versus opportunity, you can see that risk acceleration, while it was up here well above 80, approaching 90, it's since collapsed and fallen down closer to 70. Now, recently on Friday, it ticked up a little bit here, and you can see that the risk is still holding up here around 70. And again, on Friday, that also moved higher. But if we look at the opportunity level, that has fallen. It's sort of tried to come back here a bit. But if we look at opportunity acceleration, you can see that that has just continued blasting higher. So hopefully this means good things going forward over the next week or two. And what about equity versus safety? Well, if we take a look at equity versus safety, I think in my video last week, I was looking at this saying, geez, the only thing that would make this better is if the NASDAQ 100 was up here in first or second place. Well, where are we this week? The NASDAQ 100's in first place. So I'm going to put the overlays on and let's take a look, but this looks great. I love the fact that cash has totally collapsed down here in 9th place. That's exactly where I'd like to see it, 9th or 10th place. Beautiful. And you can see that we've got the NASDAQ small caps ranked 1 and 2, S&P 500 3. Interestingly enough, the long duration treasuries have kind of either bumped out the Dow or the Dow has fallen back and pushed the long-term treasuries up. But I like this. I like the fact that the equities are all up here. I like the fact that treasuries are all in a very healthy relationship here, with the highest risk, longest duration treasuries ranked ahead of 20-year bonds, ranked ahead of intermediates, and ranked ahead of short-term. This looks very good. And you'll see that gold has moved up, and you'll see why later. And I already kind of talked about this, but here's the overlay showing the Dow Industrials and the S&P 500. Let's take a look at safe haven assets, and you can see that gold absolutely collapsed down to 10th and then recently has been coming back up. But you can see that the treasuries are in a very healthy relationship. This is very much what you want to see. Let's take a look at the buying and selling pressure. Well, if you look at these, all of these are pretty healthy. You've got the buying pressure back here starting to move higher and continuing to move higher. It's well above the selling pressure here. Now it's kind of rolled off here at the end, but you can see the price movement on the Dow has been just going higher. What about the S&P 500? Again, increasing buying pressure, decreasing selling pressure, this orange line, price moving higher, and the buying pressure in this case is moving higher. What about the NASDAQ 100? Again, increasing buying pressure, although late last week the buying pressure started to decline, but the price has been moving very nicely higher. And if we look at small caps, very similar picture. So this looks very, very good. Let's take a look at ARK Innovation. If we take a look at ARK Innovation, you can see it's been struggling relative to the other indices. You can see that here in the buying and selling pressure. I mean, yeah, the buying pressure did move up here, but then it kind of started just kind of going sideways, although it was moving up over the last week or so and as the price moved higher. So hopefully this will continue going forward. What about sector rankings? Well, I'm going to, as I always do, I jump away from these and we'll look at sector rank acceleration because they give you a more real-time picture of what's going on. Although this one, this is kind of looking mixed here with, safe haven assets, gold and utilities up here, energies up here, cash is still fairly far up in the mix, although it has fallen back, so that's an improvement. But let's look at sector rank acceleration. So what can you see here? Well, it's kind of hard without the overlays. So let's jump into the overlays. The first thing I like is look at what cash has done. It's gone from third place all the way down to here into the lower half of the table. Love this. And what about technology and innovation, the riskier assets? They've all launched higher. This looks very, very promising. And then if we look at consumer staples, I like the fact that that's getting pushed lower, not because the stocks are falling, but because it's getting beat out by higher performing, higher risk equities. So that's why I put a green line here. I like the fact that this is getting pushed out of the way and lower. Now, what don't I like? Well, the big one that I don't like is consumer discretionary has fallen all the way back to here. Not quite sure what that's about. Gold has moved up a bit. That's a little concerning. We've got emerging companies, small caps have moved down a couple of notches here. And the S&P 500 broad index has kind of stayed put. So not bad, but I'd like to see that one move up as well. So overall, sector rank acceleration is showing me a very healthy risk appetite with very little cause for concern. There are a couple of things for concern here, but we'll just have to see how that plays out. And what about Treasuries? Well, if we take a look at Treasuries over the past 5 days, we've had a very healthy rally, even though it rolled off here Thursday and Friday. You can see that the longest duration Treasuries finished first, followed by 20-year, followed by long to intermediates, followed by intermediates, and followed by short term. This is a healthy appetite for Treasury risk. How about over the last month? Well, this looks great. I mean, you can see that this is a very healthy relationship. Again, year to date, we're still kind of down here in the doldrums. This does not look healthy, but we're moving in the right direction. And then if we look back over the past year, same picture, right? We're at losses here over the last year, but things are starting to move in the right direction. And what about the buying and selling pressure for Treasuries? Well, you can see that short-term Treasuries have just been kind of struggling here a bit. Even though the buying pressure has been above the selling pressure, you can see they're starting to cross here as of the end of this last week. What about intermediate Treasuries? Well, a little bit worse looking. You can see that the selling pressure is actually above the buying pressure as the prices declined here. Now, if we get out to longer duration, 7 to 10-year Treasuries, you can see this looks more healthy. Since back here, or even back here, the buying pressure has been steadily increasing overall, and the price is increasing. Now, what about long bonds, 20-year Treasuries? Well, again, back here, the buying pressure started to increase and has been increasing. Now, it fell a little bit here, but it's well above the selling pressure, and the price is moving higher. So this looks really promising. And what about that yield curve? Well, it got a little worse. This inverted yield curve got a little worse this week. You can see we're at minus 40, almost minus 41 basis points. Well, and what happened? The yields at the long end dropped a bit while these at the short end stayed put. So that's causing this to become more inverted. Now, hopefully, as we go forward and the Fed starts to lower rates, this will start to uninvert. And what do the markets think the Fed's going to do? Well, we're 3 weeks, 4 days, 4 hours, and 10 minutes away from the next Fed meeting. And you can see that this has not moved at all. I think this was at 91% last week when I did this video. So no movement here. The markets are really convinced the Fed's not going to do anything at the meeting in June. What about July? Well, that drops a little bit to 70%. But still much better than a 50% chance that rates will be exactly where they are today. And if we get out to September, now this starts to flip a little bit. So now there's better than a 50% chance that the rates are going to be lowered by that meeting. And as we get out to September, you can see that there's a better than 50% chance the Fed will lower rates by then. You can see there's only a 35% chance that rates will be where they are today. I feel like I'm afraid. And what about gold? Well, boy, I don't know what's driving this, but, gold was kind of going nowhere back here. You can see that the selling pressure was increasing, price was dropping, but lately the selling pressure is decreasing, the buying pressure is increasing, and the price is starting to go up. I'm really not sure. I'm not quite sure what's driving this. And how about Bitcoin and cryptos? Well, if we take a look at this, we're starting to see the beginnings of a rally here. Hopefully this continues. You can see that we've been kind of going sideways to down. We had a nice bottom here, and the buying pressure started to increase while the price has been increasing. And you can see that the selling pressure has been kind of on a decline here. So this looks promising going forward. If there's one thing to take away from my market reviews over the past couple of weeks, it's that the equity and bond markets are starting to look like they could really be turning around here. This is why I caution you to be an investor rather than a trader who tries to time the markets. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water.